This is the Lifetime Cash Flow Through Real Estate Investing podcast. This is where you'll learn strategies to help you achieve lifetime financial freedom through real estate investment. Your host, Rod Khleif, has owned over 2,000 homes and apartments, and he brings experts in all aspects of real estate investment and management onto the show. Now, here's your host, Rod Khleif.
Welcome to another edition of How to Build Lifetime Cash Flow Through Real Estate Investing. I'm Rod Khleif, and I'm thrilled you're here. And I know you're going to get a ton of value from the dynamic lady we're interviewing today. Before we get into that, I want to mention two quick things. One, if you're not on a list for my book, get on the list. Just text ROD to 41411. It's free. It's worth it. You'll be very glad you got it, and you don't want to miss out. That's number one. Number two, I love hearing from you guys as you're taking down deals, and I get calls from you and emails from you when you're, pulling the trigger on your first property as a result of maybe some of what you've learned on the podcast, or maybe you've been inspired by some of the driving force tips, and you've taken action. And I love hearing about that. So please give me that gift when you do that. And make sure you email me at rod@rodkhleif.com, and the last name is KHLEIF.com. So, the lady we're interviewing today is a real treat. We're very lucky to have her. Her name is Diane Kennedy. And I first found out about Diane literally over a decade ago when I read her book she wrote as a rich dad advisor with Robert Kiyosaki. It was a bestseller called Real Estate Loopholes. And since then, she's written scores of other best-selling books about taxation, finances, and wealth building. And she literally has worked and still works with some of the wealthiest people in the United States as their tax strategist. And she's learned how to make money faster and safer, than anyone else. And I'm excited to ask her about that. But what I really love about Diane is back in 2003, she co-founded a company with the goal of giving 20% of the gross sales to charity. Now, gross sales, that's top line, guys. 20% of the top line, that's huge. And they let their clients decide where that money went. I love that. But one of these charities happened to be in an orphanage in Juarez, Mexico. And the next year, in 2004, she and her husband, Richard, visited that orphanage in Juarez with a film crew to record that story, and they ended up adopting a 13-year-old boy from that orphanage. And that boy, David, is their son, who they love very much. I don't know Diane that well, but I already love this lady. Diane, I am so humbled and extremely grateful that you're on the show.
Oh, thank you so much. I look forward to talking about real estate and all kinds of things. It's kind of an exciting time right now.
Yes, it is, and lots of stuff happening. And where are you talking to us from?
I'm actually talking to you from my home office in Baja California, which is Mexico. We're about 40 miles south of San Diego, and I'm looking at the Pacific Ocean right now out my window. It's a beautiful day here.
Nice. Well, maybe you can start, just tell us a little bit about your background. I mean, I touched on certainly your successes and things that I love about you, but talk about, how you got into the real estate business. I believe you've been an investor, correct? Or are an investor?
I have. Yeah, I actually, before, I became a real estate investor before I was 25. So, wow. But I came from a family that did that. My dad's whole deal was he was what I call a serial entrepreneur. He'd start little businesses and sell them. And then what he always did is invested the money in real estate. So for him, it was, okay, business is how you make money, and then you hold your money in real estate. And then, of course, you make money from that, and that becomes passive until you eventually don't need to work anymore. And so that kind of simple philosophy was the same thing I did. And that actually led to me initially meeting Robert Kiyosaki, because he'd done something very similar, had a lot of real estate. And boy, I'm aging myself here, but he became a client of mine in 1983. And it was because he had some kind of sophisticated real estate tax issues. And I was already very focused in doing tax advice for sophisticated real estate investors. And so it was kind of a match that worked well. It was before he'd written Rich Dad, before any of that happened.
Wow.
He was a client of mine because of real estate.
How impressive. Wow, that's very cool. So tell me, I know you're an expert as far as tax strategy and tax breaks. Can we talk about that a little bit? I definitely also want to talk, because I know you've got a lot of feedback to talk about, what we can expect with the new Trump presidency. But let's talk about tax strategy first, if you don't mind. I want to hear about, how multifamily real estate investors can capitalize on tax breaks.
I think that probably the number one thing that we talk about with real estate is it's one of the few investments that you can make that give you cash flow, appreciation, and it's tax advantage. There's tax breaks. So focusing just on that third one, the tax breaks that you can get, a lot of it's going to depend on your personal income level, how much money you make, and how you make that money, whether you're what's considered a real estate professional or not. But besides that, it is one of the few, I can't think of any other investments that you can take cash flow, honest to goodness money you put in your pocket, and not pay tax on it, and do it completely legally. So because of the way the tax laws are written, you have depreciation, which is this wonderful expense that can offset income. You can also do some kind of sophisticated things and create tax credits, which are direct deductions from the tax you pay. And by the way, you can sell those on an open market before you even create them. I have clients who do that to fund their other investments, especially when it's large multifamily projects that they're either rehabbing or constructing. So I guess it's just, what would you like to do? And if you can figure it out with real estate, there's rules you have to follow, and you just need to know the rules and have planning ahead of time.
Wow. I don't know a thing about tax credits, and I think we could probably do another section on that, but that's something I would like to explore with you sometime. But let's talk about what you think is going to happen with Trump. What do you think tax wise, and if you own real estate, what do you think could happen?
Well, maybe we could start with kind of a segue off of that.
Okay.
Is there's quite a bit of a hoopla about when the first couple of pages of the tax return were leaked to the press, and it showed a huge loss. And you might remember seeing that there was a loss of about $15 million that was on the line for Schedule E. Now, that's either real estate you directly own or you hold through a single member LLC where it's directly reported on your Schedule E, or it's coming through pass-through entities, most likely because of real estate. And I think that's one of the most telling things. Let's look at what he did. And so we didn't see Schedule E, but I think we can surmise from that he had properties that he was able to accelerate depreciation on, and there's some strategies for doing that you actually end up, although you have cash flow positive properties, you have a legal tax loss, and that then can be a deduction for you. Interestingly enough, is that now that he's about to be president, he's going to lose the ability to be a real estate professional and not take all of those flow-through losses anymore. So it's not even so much that he's not getting his. I know it is. It's kind of like, wow.
Wow. Yeah, because you have to have 700 hours or something a year towards real estate, and he certainly can't pull that one off. Yeah.
Well, yeah, not only that, I mean, the first part of that is 750 hours or more, and you have to spend more hours doing real estate than anything else. Well, I'm pretty sure being president of the United States is a full-time job. And so it's going to be hard to be doing real estate on the side.
I wonder if he thought about that. Because that is going to hurt him with that big loss carry forward. Wow. Holy cow.
Yeah. So that's, but that, obviously really big numbers with lots of zeros, but that's exactly what any other real estate investor can do if you meet that criteria so that you can take those losses.
Yeah, and there was a lot of people there were a lot of people really upset about all that. Oh, look at all, look at all these losses he's taken. But guys, that's the advantage of real estate. It's so beautiful. I mean, he just followed the law. He just, took what's legal. And anyway,
I know. Yeah, and so but it's interesting when we look at and we read his plan, as well as it sounds now like the House plan under Kevin Brady is going to be. So we're going to end up with kind of an amalgamation of the two, and neither of them. There's lots of changes, but neither of them talk about any changes to real estate tax. So I believe we're not going to see a lot of anything.
Good.
I wonder with kind of his personal experience with the IRS, if we might see them kind of reining back a little. My guess is that the ongoing audits he's had are quite possibly as a result of real estate, because since 2008, the IRS has sometimes been aggressive in auditing real estate investors' tax returns that have big passive losses. And they've already announced they're going to go after another group, which is non-filers. And so I have this feeling that we're about to enter the golden age of real estate tax planning, because there's nothing that seems to be changing in what we've got. And it's been around long enough. We've got case law. We know very clearly This is what you need to do if this is your circumstances. So, and just to kind of go over what that means is if you make less than $100,000 as just adjusted gross income, that's the bottom line on your page 1 of your Form 1040. If you're less than $100,000, you can take up to $25,000 in real estate passive losses. If you make over $150,000, you can't take anything. The amount you can deduct between $100,000 and $150,000 of adjusted gross income phases out. The way around all of that is to be considered a real estate professional. And those are that was the part we were just talking about. Where
right.
You have to spend more hours doing that than anything else. You have to participate in the properties. I mean, there's some specific rules you have to follow. But if you follow those rules, then you can have massive write-offs against other income. And that is a huge, just a bonus that you get for being a real estate investor, not counting the fact that you've got cash flow you don't have to pay tax on, and appreciation you can go get loans against that you don't have to pay tax on.
Sure.
So it's a way of generating cash and not maybe ever paying taxes.
Right.
Legally.
If you never sell the properties, you really don't ever pay taxes. It's and you can pull money out through, like you said, through refinances, and I mean, and the write-offs are just fantastic. Now, I know you were alluding to accelerating depreciation. I'm assuming you're referring to cost segregation.
Absolutely, yeah. Cost segregation studies. And it kind of, I mean, maybe the simplest way to discuss that is, let's say you have a multifamily residential property and you have units in there. And within your unit, every unit has a kitchen. So in the kitchen, there's a garbage disposal and a dishwasher, and you have an HVAC system, and, you have components in there that don't need to be depreciated over longer lives. Typically, residential buildings are 27 and a half years. But these are often 3 to 7 years that you can depreciate those over. So what you do is a cost segregation study, and it pulls out the value of those items, and you can then depreciate over a much faster time period. Now, it doesn't create depreciation. All you're doing is front-end loading it. So if you go into that strategy, I always advise my clients that you be thinking about, in about 3 to 5 years, you need to be buying additional property.
Right, because you're going to need additional write-offs, to offset that income. But if you need it right now, I mean, I did it in 15, and it saved my bacon. I didn't even really know about cost segregation, and I was looking at I think about a $300,000 tax bill, and I ended up with a big savings, and it was perfect. I mean, so it really helped me. I had a client who went from paying $80,000 to just paying nothing. He saved $80,000 in taxes last year when we did that. And he didn't need to buy anything. He didn't need to do anything. He was already qualifying as a real estate professional. It was just a matter of doing this cost segregation study. Right.
And I always think it's interesting because the IRS is kind of forcing you to continue to buy property, which if you meet people that have got long-term wealth, they've got real estate, and they have a plan to continue to buy it.
Yeah.
So it's not just, I bought this house back 25 years ago, and now I'm retiring. No, they had that, and then they bought some more, and then they bought some more. So the IRS, it's like they're helping you be rich.
Right.
But you just have to follow the path.
Yeah, that's right. And if you're continually investing, you're going to continue to have those incredible write-offs, and you literally can go through life without paying any taxes. I mean, it's a legal way to do it, and it's fantastic. So, I know you've got some really successful real estate investing clients, and what trends are you seeing in their investments? I mean, what are you seeing?
Well, for one thing is that they're very bullish. I mean, they're definitely getting in there and getting properties. They generally, though, I would say if I were looking at the entire U.S. as a whole, there's pockets that are better than others. And so if it's residential rentals, they're looking for where's places that have strong rental pools. They don't want to go in an area that has just one industry because that industry leaves, you're done. I mean, look at Detroit.
Right.
So they're looking at areas that have multiple industries. Another thing, and I haven't mentioned this, but I have a large client base that are foreign. They're foreign nationals buying in the U.S. And it's really interesting to see how many people are buying into the U.S. And these are just kind of average people. They pool all their money in their family because typically they can't get loans. And they're having to pay higher property management fees than a person who lives in the U.S., and their tax rates are higher. And yet they still see this as such a huge buying opportunity in the right areas in the U.S. So I often think that's interesting. It's like we have such an advantage. And other people are making money on this, and it's even better for us.
No, it is. And the fact that we're drawing so many non-domestic investors, they see the value in multifamily real estate. They see, the fact that that they can do better here than they can in their own countries, and it's very exciting, and it's going to continue to drive the market. So, I know you also are very good with managing risk. Can you tell me, maybe make some suggestions for minimizing risk for people that are investing in real estate? And maybe we've already touched on it, but if you've got any thoughts there.
Sure. What's interesting is that I do talk to people that know someone, or they personally went through a really bad time, 2008, 2009. And I can also tell them the story of clients that I have, that it was like nothing fazed them. Now, very possibly their properties were devalued during those times, but it was on paper. If they weren't trying to sell, it didn't matter.
Right.
The whole thing was cash flow. And actually, for people that were renting out properties, in some ways, those were great times for them because people were buying houses who really couldn't afford them. And so they needed to go back to finding more affordable choices, which tended to be being a renter. So the rental pool grew again. And as a result, they had more people to rent their properties. The key, though, in all of this, I think that it all happens when you buy. You need to buy something that is going to be a strong rental pool and that's going to provide cash flow. Sometimes I see people fall in love with the property, and often it's because they've fallen in love with some story that it's going to be something awesome someday, some future day. I personally don't like those kind of stories.
Right.
I want to know what's happening now. And it could be. I mean, I could be walking away from a lot of money when I do that, but for me, managing the risk is more important. I want to see something in a pencil now.
Agreed. And it's empirical. It's not, there's no subjective nature to this business, particularly in multifamily, because the data is there. You look at the numbers, and, you were hitting a pain point with me about 2008 and 2009 because, in 2006, the net value of my real estate went up $17 million in value. Okay, I mean, I did the math on that. It was like $3,500 an hour, I think, or something. It was an insane amount of money. But of course, then 2008 happened, and because I was focused on value instead of cash flow, I got my clock cleaned in my single family real estate. And the reason I started this podcast is because, I had 800 houses that I ended up losing in 2008 and 2009, but my apartments did just fine, and because they were cash flowing, and that's why that's the main reason I put this podcast out there, is to let people know that. And the title of my book is The New Rules of Real Estate Investing. The new rules are focus on cash flow. Don't focus on value. Value is irrelevant, because when we have our next contraction, because we're going to have one, and it could be happening now, who knows? But when we do, those of you that focused on cash flow will be just fine. But those of you that are focused on value are going to get your butts kicked. So, that's it's funny that you touched on that, because that's the whole reason I'm doing what I'm doing right now. So,
your story is so absolute relevant. I mean, that's my clients. I've got people that have gone through that, and then I also have clients that were always about the cash flow. And there came a point when values were crashing. It's like, okay, I have to stop looking at the news, because it doesn't matter if the check shows up tomorrow. None of the rest of it matters.
Right. Who cares if the value's down? Now, I will give you a caveat, though. Let me tell you the one caveat, though, Diana, and I'm sure you'll agree, that you want to be very, very careful as it relates to your debt. Because if your debt comes due when the cap rates have expanded, you're in trouble if you can't refi. So that's like people that are buying right now, they're asking me about that, and I tell them, get 10-year balloons. Don't do 5-year balloons right now, because you don't want to be in the middle of a down cycle and have the cap rates go up. And as you guys know, the lower the cap rate, the higher the price. If the cap rate goes up, the price goes down, the value goes down. And if you're trying to refinance and the numbers don't make sense to the bank, you could be in a problem, even though you are cash flowing. It's a horrible situation when that happens. So very, very important to focus on cash flow, but also be careful you don't get yourself into dangerous debt right now, because contraction will happen, and when it does, you want to make sure that you can survive it. But that's the beautiful thing. You're right. Value is irrelevant. So even if your values plummet, if the cash flow is coming in, who cares, right?
Right.
Yeah.
Yeah.
So
that's excellent advice. And if I could kind of tie it back to an earlier question, because I just had an aha moment. Thank you.
Okay.
One of the things that President-elect Trump has said is that he plans to deregulate some of the financing that's available. Mm-hmm. I suspect we may kind of see a pendulum swing back to everybody gets a house. And if that happens, then we're about to have a run up and a run down again. And the 10-year balloon, that 10-year period, it would go up and down within that period. So I think that's very wise advice.
Oh, thank you.
5 years isn't enough. You might be in the middle of it.
Wouldn't that be fantastic? I'd love to see a run-up like that again. I know he's been talking about eliminating the CFPB, the Consumer Financial Protection Bureau,
right.
and that's that's the one that's been regulating this whole process. So we'll see if that happens. So what other mistakes? Maybe we've touched on them, but what other mistakes do you see people making when they invest in real estate?
I think sometimes they. I keep calling it that they fall in love with the story instead of what the numbers are.
Right.
And I'd love to live here. And it's like, well, you're not your tenant. So, quit trying to think like that. Or it's going to be, they're going to build. And it's like, yeah, but they're not doing it now. So don't get sucked into the drama.
Right.
What do the numbers show? I had an interesting client. This is actually in Phoenix, a client who lived in Phoenix, and he was a broker. And this was before we had the run-up, so this is kind of an old story. But his whole process was he had a computer program that just crunched numbers of all of the commercial, the multifamilies that were available. And so he was looking for anything that was like off a norm. So it was too high or too low. The cap rate just didn't make sense. And then whenever he found it, he'd go dig into it. And he found a very large property where they had made a mistake in the calculation, and they'd overcounted. They doubled up the amount of property tax. He went in, made an offer, bought it, turned around and flipped it, and made, about $500,000 in the flip because he just corrected what the financials were. I don't recommend flipping.
Right.
But but it's interesting because the numbers are everything in this game. And, if you're looking who's going to buy your apartment house, it could be a pension plan, and then they probably won't even come out and look at it.
Right.
Because all they care about are the numbers.
Right, but when I want to back up with what you just said, this guy that looks for anomalies, because that's brilliant.
Yeah.
And that's what we do.
Yeah.
And, we found deals on LoopNet. People say LoopNet is a place where deals go to die. But if you see a property that's been on there a long time, and particularly the ones that don't have all the information, like we had a property where it was like 90-year-old sellers and everything was handwritten and there was no information. And it was a phenomenal opportunity because, not only were the rents not at market, but they were getting screwed by their subcontractors, and it was just a phenomenal opportunity. So if you dig into one of these deals like this guy was doing, look for an anomaly and dig into the deals. That's a brilliant strategy, I have to tell you. I hope you guys take notes on that one because if you're looking at a deal and the expenses are more than 50% of the gross revenue, then something could be off. And sometimes that's a very easy fix. So that's a great way to identify a potential problem. And then, of course, you look at the market rents and see if the market rents for that property or what that property is rented for. That's another opportunity, but it takes a little digging in. And sometimes people will just see, it's a 4 cap. There's no way I'm going to buy it. But if you dig in, you'll see, well, wait a minute, they're running at a 70% expense ratio, so they're paying way too much for something. Dig into these deals. So that's very good advice. Are you investing right?
That's so funny you said that.
Yeah.
I was just going to say that's so funny that you said about the handwritten things because I've actually run into those sometimes. And people, I think sometimes two people buy and they don't keep good track of their numbers.
Right.
You can hire a bookkeeper. You can do it yourself. Once it's set up, it's actually quite easy to do if it's just set up properly. Using QuickBooks, Yardi, or whatever you're using.
Right.
But really, you've got to know your numbers so you can watch those.
Right.
Yeah, good advice on the numbers.
No, thank you. So, are you investing right now?
We've done a little bit, and we're just kind of watching to see what's going on.
Right.
We've tended to be in areas where we feel like that we're really comfortable in knowing what's happening. And again, like I said, that we wouldn't go into an area where there was just one employer. So we're it seems to me that we're seeing a little bit of the zombie foreclosures are starting to hit the market. I don't know if you've been following that over the last few weeks.
No.
Suddenly there's big peaks on foreclosures in some areas, and it looks like they're the ones that the banks have been holding kind of
they're
on and off their
refiling.
books.
Yeah, got it. That's absolutely happening here in Florida as well, because it was just a Supreme Court thing, and they lost the whole argument about the statute of limitations on refiling a foreclosure.
Right.
So we're seeing a surge here. Yeah. No, we're definitely seeing that, and there could be some opportunities, from an investment standpoint on that. But okay,
yeah.
Okay.
So, and I'm not sure how that's going to impact the market. So,
right.
And I tend to be quite conservative. So my husband is not.
Well, you're a
as
CPA for God's sakes. I mean, that goes with the territory.
Yeah, exactly.
Right?
Yeah. And my husband's an engineer. So we
good
both
God!
Like
That's both of those very, very analytical occupations and right next to each other. That's. I'm surprised you even invest, that you don't get caught in analysis paralysis. That's it's impressive. I'm just teasing.
But
so.
No, I know, but it's for me. I don't know what's going to happen with that, but it's interesting when you see the things that are happening. And there's some areas in the country, for example,